Welcome to SB Talks. Today is Wednesday, July 26th, and I'm once again joined by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vincent.
Now, Nick, I think this week we will start stateside, where we're now about 1 week into the US reporting season, and some positivity to report there.
So we've had about a quarter of companies in the S&P 500 report their second quarter earnings, and by and large they've been pretty good. So the companies that have reported so far have beaten estimates by around 5%. Although earnings in aggregate for this reporting season is still expected to be down compared to the same quarter last year, largely due to energy and materials companies, which obviously are going to report softer earnings.
A bit of an anomaly this time last year.
Yeah.
So by and large beating estimates, is that because estimates were less ambitious as well, or we are seeing genuine solidity in terms of earnings growth?
Well, I think companies always beat their earnings estimates. They're generally fairly cautious in providing guidance, setting low bars, and we've seen 77% of companies beat estimates. That's probably about average compared to history. I think there's been a couple of things that have stood out for me. One, the banking sector, which is normally the first sector to report. Those earnings were actually not too bad. I think people were worried after the collapse of Silicon Valley Bank that we'd see some bad numbers.
A bit of a bellwether at the coalface of the economy there, so a lot of eyes on how they report.
Yeah, so JP Morgan had a great result. Wells Fargo, Morgan Stanley did quite well. So yeah, some of those banks weren't too bad. Even some of the second-tier banks like Zion Bancorp, etc., weren't as bad as feared. So we saw quite good price movements over the past week after those banks reported.
Generally adding to just a broader sense of optimism when it comes to US equities, certainly over the last 3-4 months. Yeah,
well, definitely it's helped. So the US equity market is now the highest since April of 2022. So we've seen, pretty much almost a full recovery of the losses last year. Really helped by tech, and we had a couple of tech names report last night: Microsoft and Alphabet.
Yes. And earnings surprising on the upside there again.
Yeah, Microsoft reported 5% better earnings. In the detail, it was pretty good. Like the cloud service was much better than expected. I think, though, there was a little bit of disappointment about the cost line and the capital amount being invested. So they had the biggest capital expenditure since 2016.
AI related?
Yeah. They're trying to buy chips and build data centers to kind of continue that growth in the cloud service.
And they've recently rolled out their Copilot offering. I think it's about $30 a user a month. Probably won't have really seen the impact of that in this earnings season yet. So that's investment for, I guess, future revenue to come.
That's right, yeah. And Alphabet also had a pretty good result. Its earnings are up 20% year on year. So, certainly that momentum that people were thinking maybe some of these companies are going ex-growth, but that certainly wasn't the case.
The demise of big tech has been overcalled there, certainly.
That's right.
More broadly, outside of the market, still seeing some other positive indicators in terms of the US economy, housing and other places, consumer confidence?
Yeah, so we had a good consumer confidence reading in the last few days, much better than expected, really driven by perceptions that there's still a very healthy jobs market and there's plenty of jobs out there, and I think that and I guess fading recession fears is helping the consumer, and also house prices. So house prices rose 1% in May. That's the fastest rise since May of 2022, and prices are just less than 1% below their June 2022 peak. So despite all the interest rate rises, it really hasn't flowed through into house prices to any great extent. Due to probably a lack of stock as well. People are staying pat in their homes, not wanting to give up their cheap mortgages.
Yeah, no, we've spoken about that one on the podcast before. In the US, if you're financed in for a 25, 30-year fixed-rate mortgage, that's a very large disincentive to move home and have to refinance. But broadly, I guess a lot of positives there and a lot of resilience in terms of the economy, which gives the Fed a lot to think about. It did a hawkish skip/pause last month, meeting again tonight or at present. What's your thoughts in terms of where they go now, back onto the raising
Yeah,
cycle?
so I think it's almost universally accepted that they'll be raising rates tonight, 25 basis points. It's fully priced by the market. I think will be more interesting to pore over is Jerome Powell's post-meeting press conference and the statement that comes out. Really trying to get a hint as to whether there might be another rate hike down the track. I mean, that's certainly what they were talking about with the two rate hikes in the dot plots at the June forecasts. But markets weren't really buying that. So we have one fully priced for tonight, and then we have half a rate hike sort of baked in for, I think, by October.
So what we're saying is, let's just take another 25 basis points is pretty much in the can, and then one more 25 basis points, probably 50-50, whether we get that or not, data dependent. And so far, the data looks very strong.
It does. Well, it looks strong, but obviously we had that June CPI print that came in a little bit better than expected. So core inflation ticked down from 0.4 to 0.2. And that was pretty encouraging. And people are now talking about what they call immaculate disinflation,
right?
Which is basically inflation coming down.
Some phenomenal creativity here in the finance scene.
That's right. So inflation coming down all on its own without, unemployment really having to tick up in any meaningful way, and growth kind of hanging in there. So
just feels too good to be true, that very ultra soft landing strategy.
It does, but certainly the markets are taking it all in their stride, and they're liking it. So that's the narrative that's sort of currently out there.
And I guess at the very least, whether there's a recession or not, it's about how deep and how long it is. So that this sort of health of the economy at least gives you increased confidence that it's not going to be a particularly deep or protracted recession, which is probably what the markets are looking at more than anything else.
Well, if there is a recession, that's right. Yeah, it would be fairly mild, certainly given the health of the consumer and the housing sector and the jobs market. It's really hard to see, firstly, how we do get a recession, but secondly, how it would be a severe one.
All right, so immaculate disinflation. Let's see if that trend continues. Hopefully it does. A little bit closer to home. Some Australian inflation data, and I'm conscious that at the time of recording we're probably a couple of hours away from the latest inflation print here in Australia, but what are we seeing and what are we expecting today?
So the expectation is that trimmed mean inflation, which is what the RBA really cares about, will print at 1.1% in Q2.
Maybe help us understand what that trimmed mean measure is made up of.
Yeah, so what that does is it strips, I think, the top 15% of items and the bottom 15%, and then just takes the mean.
So trying to take out probably the outlier items that might be subject to more idiosyncratic factors.
Yeah, the more volatile items that kind of at the top and the bottom end of the range. So taking the core 70% of items and measuring the mean change for those. And that's one measure of underlying or core inflation that the RBA likes to focus on. That's expected to fall from 1.2% in the first quarter to 1.1%. So not a dramatic downshift, but if it does come in at that, that's broadly consistent with the RBA's own forecasts. And so then I think you'd be talking about a kind of coin toss at the next, at the August RBA meeting.
If it continues to just show some positive signs of easing there. Also closer to home, much speculation and focus on the latest Chinese meeting of the politburo there, and obviously it's all about stimulus, and we got a hint. Is that how we best describe a hint? We really didn't get anything of great substance, unfortunately, but maybe an indication that there might be more to follow in the stimulus front there.
Yeah, I think a lot of people have been hoping. Well, they've been disappointing with the reopening story in China. It hasn't really translated into a kind of meaningful uptick in growth. The consumer there is still fairly downbeat. And so I think people then had turned their focus to this politburo meeting, hoping that there would be some sort of announcement of certainly widespread stimulus, and that certainly wasn't the case. There was no what they call irrigation stimulus, where they just throw a lot of fiscal stimulus or even monetary stimulus around. So we haven't really seen any evidence of that. I think what did come out of it was maybe they are more focused on measures at the margin to improve the property market, which has really been in the doldrums. So, for example, they had previously spoken about housing is for living in and not for speculating, and that had been a big focus given financial instability risks and things around that.
The property market had been such a big driver of their previous stimulus initiatives.
But that comment was removed this time around, so people took some encouragement from the removal
what wasn't
of that.
There. Yeah.
Yes, that's right. So I don't think we'll see a massive stimulus there, but maybe at the margin it does help a little bit with their economy.
And anything else catching your eye in terms of your thinking around clients and portfolios? I would suggest that probably when we sit down to record the next podcast in 2 weeks' time, we'll actually probably have a lot more information at hand between Australian inflation, RBA meeting, and the Fed will have met and sort of released various statements by that time. Anything else catching your attention?
Not really. I think obviously the progress of the reporting season is important. The Fed meeting, the ECB meeting, and the Bank of Japan meeting later this week. So it's a big week for central bank meetings. They'll also be important. We'll have had the RBA's August meeting. So there's a lot on over the next few weeks. I don't think there's anything that we've seen over the last few weeks that would change our views on markets. I mean, it is clear we are getting quite close to the end of the rate hike cycle. But maybe one or two hikes away.
Yeah. Very, very interesting as always, Nick. Thank you very much. And thank you to all our listeners. We'll speak again soon. Take care.